Welcome to On the Edge, a show examining how deals actually happen in commercial real estate. Host Malcolm Davies, founder of Way Capital, speaks with professionals in development, investment, finance, and more for insights into how these business leaders get deals capitalized. Malcolm's career spans more than 20 years, during which time he has managed nearly $20 billion worth of financings. Now to your host, Malcolm.
Hi, everyone. Welcome to our first ever On the Edge podcast at Way Capital. I am honored to have really one of my great personal friends in the business, Mr. Bryan Gross with Arena Investors, to kick us off on our inaugural podcast. Hopefully we'll do this right. But Bryan, welcome to On the Edge.
Thanks, Malcolm. Appreciate you having me, and congrats on the inaugural podcast, and hopefully many more to go.
I love it. So, and we'll look back at this in hopefully 10 years and say we'll look a lot younger or something, who knows?
That's for sure.
So, all right. Well, now first question is, where are you in the world today? So you got a great background there. So tell us where you're at.
Sure. So I'm in Westchester, New York, actually sitting in my wife's office. So it was previously a screened-in porch, and during COVID, everybody needed a house project. So we converted our screened-in porch into an office for her to use, as well as our kids down the road when they have homework, and will leave us alone in at least my office.
It looks awesome, by the way. So,
Thank
all
you.
right. So tell us about, not only yourself, Bryan, but who Arena Investors actually is and how it relates to doing really creative and unique commercial real estate transactions.
Sure. So Arena started about 9 years ago by Dan Zwirn. We are a $3.5 billion multi-strat AUM credit manager. We're special situations focused. And while I'm in the real estate group, we do corporate private credit, structured products. We have a liquid trading business. We do secondaries. We're headquartered in New York, but we have offices around the world. So we are truly multinational, being in London, Dublin, office in Singapore, office in Jacksonville, India. We have a big investment in affordable housing in New Zealand. So we really, run horizontally across the gamut in finding opportunities across the globe we're chasers of illiquidity. So we provide that capital during that time, and it's shorter duration capital, but it allows us to be flexible in doing things that we want and finding the best opportunities over time.
So when you focus on illiquidity, I think that's a really great place for us to start. While we may not be in a very entirely illiquid market, we are certainly in a capital and basis starved market where we are looking for really unique sources of capital to solve, challenges in the commercial real estate industry. So maybe chat about some of the things that you're doing right now that are interesting for our audience to learn about.
Sure, absolutely. So, what are we doing today? It's a great question. One of the things we're doing is trying to be most efficient in our selection of deals currently, right? So think about it how it was a few years ago. Right now, we are seeing a ton of deal flow. And I think a lot of that is a result of distress and stress in the market. And because of that, we're seeing these transactions coming in multiple ways. Is a recent example. We saw a regular way financing a few years ago. We passed on it just because of absolute pricing. It didn't fit our yield profile, but we liked the credit. We saw it last fall when I was looking for the refinance on the initial loan. There was maturity. We saw it through the same broker. That refi that another group ultimately was looking to do didn't get done. Now, fast forward 18 months after the loan was done, we're seeing it as a potential NPL opportunity at a lower basis than we saw it 2 years ago. So whether we pursue that NPL remains to be seen, but we're being super selective. The other thing in terms of how we're getting deals done right now is that I think time kills deals. And because lenders have the power right now, borrowers are feeling that pressure. Either there's an expensive extension coming, or a maturity default kicking in, the lender saying, we're not giving you any more chances, no more extensions. We're able to come in, move quickly. And while there's a cost for that speed to execution, ultimately, I think borrowers are needing to determine how they're going to go forward because there's a cost for that certainty of execution. The final thing I'd say is that, our mandate as a special sit credit fund is that we don't subscribe to there being to having a long put option to us, given that investments historically for duration had been 3-1-1 type deals. So you ultimately end up being 4 to 5 years duration if the deal's going poorly. And if it goes well, the prepayment premium is pretty short and they're going to refi and you're not going to get that. So while others are looking for that duration, we structure our loans with a shorter term investment horizon, inclusive of extensions. And we push performance milestones within those. So it's heavy in structure. That way we can hold the borrower to their business plan. Now, the trade-off for them is that our cost of capital isn't cheap, but
Sure.
It can go away more quickly on a relative basis than those borrowers that have it be extended out. And that's how we get repeat borrowers and are able to do that and build the relationship business over time.
Would you, look, one of the dynamics we see in the markets is the relationship absolutely matters. It is so critical in that communication between the parties. We see as the foundation for any relationship, regardless if it's an equity partner or a lending relationship. How have the existing borrowers or existing groups that you do business with, do they transact with you significantly over and over and over again? And, maybe talk about how you find the deals that you find that are interesting for Arena to be involved in.
Yeah, sure. So we have our fair share of repeat borrowers like other credit funds where they know what's expected. We hold them to their word that they're going to affect their business plan. So how do we see deals? We see deals through multiple different channels. One channel is obviously the broker network. We know you, have known you for many, many years and have done a lot together. We have correspondents, we call them advisors, that carry Arena business cards and Arena email addresses, and they are going searching for opportunities on Arena's behalf. And what's critical to that is the alignment of interests. So we are focused on, in everything we do, that alignment of interests. So with our JV partners, we've done probably in the real estate space about 25 different JVs since we started the firm about 10 years ago. I'd say 9 or 10 of them are active. And each one of those JV relationships have their own distinct, unique strategy. So what that allows us to do is maintain variable cost flexibility. And that way, effectively, we can get the milk from our partners' domain expertise without the fixed infrastructure costs. And we'll structure that where it may be a 90-10 structure, 85-5. It doesn't matter what it is, but the capital that they're putting in alongside us is meaningful to them and their day-to-day. And we have major decisions and we're working alongside as partners, not to do 1, 2, or 3 deals, but to cross all the cash flows into a mini JV vehicle and have a short duration of that investment horizon. And then when things go well, let it run off and start series 2, series 3, and so on. That's been a really strong avenue for us to do. And each one of those JV partners has a particular business strategy that is unique, unlike the other ones.
And is that geographic focused, asset focused, structure focused? How have you created those 25 separate JVs with different groups?
Yeah, it's all the above. So we like to see them having a particular domain focus that is asset class and geographic focus. So while we may have an operating partner in Southern California, he's able to know the market because maybe he's operated there on an equity basis previously, but he's been in the lending space for a number of years. And he has that focus to be able to operate as well as see the world the same way we do so that we can collectively prosper.
So the world today is certainly different than it was 24 months ago. it is a place for where the creative capital comes to play. How are you seeing the current environment with either JV partners or lending opportunities, short-term duration investments, anything and all the above? When someone thinks of Bryan, thinks of Arena, how should they think about the opportunities that they might want to think about presenting to you? So obviously we know, the brokerage community and the consultants and the correspondents that you have, but there are going to be a lot of groups that will be watching this, and they think about, okay, where can I kind of slot Arena into our portfolio, and where those needs might be? Is that short duration? Walk us through that?
Yeah, sure. So I think the investment universe, across cycles, there's always a pendulum swing, right? So this period of time that we're in a rising interest rate environment isn't unique. The question is, how many debt funds have been raised in the last year? Hundreds, right? Yeah. Now, how many of those are coming from the equity side where they're getting into the debt space for the first time, and they don't necessarily have that background, but they're looking at yields and say, listen, I can't get a development equity yield or value add the same way that I can get a bridge to stabilization. And so they're pricing their capital in a way that debt groups are. So that's why there's been a huge focus and movement in everybody wanting to do debt. We're seeing opportunities on thinking about it as two sides of the barbell, but not necessarily in between. On one side is the scalable, homogeneous deals that would be middle of the fairway. I like to use golf analogies because I'm not the best golfer, but to use that analogy, we may touch the short rough, and that may be given a particular market. It may be an emerging manager or sponsor who's not as bankable with a large debt fund, or it may just be the middle market space. In that, we can find a little bit outside, price yields than what we would otherwise see. And so that's a business we've been focused on. Those are bridge to stabilization type product, where we can be the casino and not the gambler, right?
Sure.
He has a business plan he's trying to execute, and we're giving him the capital, albeit with structure, to let him execute. The other side of the barbell I think of as busted deals, where maybe the underlying real estate is solid, but there has been, or there's soon to be, a catalyst event that will inherently unlock value. So those are more idiosyncratic in nature. And I'd say this as it relates to it, though, that we position ourselves in the capital structure to find a way to protect our investment first. And then if there is outsized opportunity, we may go deeper in the capital structure, have participating equity component. The one thing, to note is we are looking for appropriate risk-adjusted return per unit of duration, per unit of correlation, in what is the best opportunity for us. And we see this in real estate. And then as a firm, we look at this horizontally across other investments. Where is the best place to price our money? So we have a pretty broad mandate within the real estate group. I'd say, however, though, that is focused on the middle market space, probably $10 to $50 million ticket sizes, and shorter duration than one would typically see in debt funds. So we want the borrower to execute their business plan. That way they can go find cheaper costs of capital in the perm debt markets, be it balance sheet or the conduit markets, and we can go find the next opportunity and not be the long put that I mentioned earlier.
You mentioned something about participation and the like, and that comes with presuming going higher in that capital stack than maybe others might go. Maybe chat about that part and then how that functionally works. So in essence, you're coming in, rather than going up to some LTC or LTV perspective, you're going to go a little bit higher. You're going to allow the business plan to effectuate. But because you're going higher and you're taking really last dollar equity type risk, you're going to not only take the yield from the coupon, you'll take a profit participation along shoulder to shoulder with the borrower. Maybe chat about that a little bit.
Yeah. So one correction is that we're not taking last dollar equity risk. That's the critical component.
Yes.
If we see an opportunity that there's a way for the sponsor in the short term to unlock value, we will structure a unitranche deal and maybe have a piece. It doesn't matter how we slice it up, but we will take a component of it because we'll balance sheet everything and we'll allow him as more of an equity kicker, right? So we're still effectuating getting our returns for what would be a coupon, and we're fine that way. However, if there's upside, we're giving some equity dollars in the short term and we're getting a piece of the pie. So when we look at deals, we're looking at how much is the borrower getting relative to the pie versus us.
Yeah. And I think just in general, this goes back to the point about how many repeat borrowers or repeat relationships you have. I think nothing comes free in this world. Nothing is overly inexpensive in the capital markets today, but it's about what can you provide to get someone to effectuate that business plan. We've never seen a larger spread between transitional cost of capital versus a stabilized cost of capital. At least in the last 15 years, there's never been a greater spread. So in short, Arena allows you to get to that lower cost of capital to ultimately exit you, maybe in a more of a creative fashion than you could from another avenue. And that relationship is key. Go ahead.
Yeah, I'd say one additional thing is that while size is important, right, because it doesn't make sense for us to do small one-off deals. It's just not efficient from a variable cost perspective. But if you can create a mousetrap in doing a small size deal and have that be scalable, while it's not interesting for a $400,000, $500,000, $600,000 investment, if you can do 20 of those in a short order period because it's a very simple business plan, that to us is interesting.
Right. I think that's where you and I have talked over the years that being able to be creative and not have a box. And I think that's one thing that we notice by doing business with you is that, while having a box is easy when the world sees it, to just present those things, but it's the creative, unique opportunities, the special situations that it seems that Arena really excels at. You mentioned something about middle market and what that means. And, I always think about what is middle market? Well, middle market's where the entrepreneurs really sit. And, we as a firm do a lot of business with entrepreneurs doing institutional level deals. It seems like that's a place that you guys have focused on too. It seems that there seems that some dislocation opportunities are. Maybe tell us why that you see that as the place to spend time.
Yeah, I mean, I think when you look at your gateway markets, there's a lot of institutional investors. One, they're either international or national investors feel a lot of comfort in tighter cap rate gateway markets. So because of that twofold, one, the cap rates are tighter, the pricing is tighter, and that's what they're looking for. But also you see a lot more quality real estate if you're doing the middle market space on a larger size relative to the more institutional type funds out there that are focused in the core market. So for us, middle market is size, but it's also geography.
Mm-hmm. So, not to get every tertiary market deal ever to come to you, but would it be safe to say that you're doing deals in these secondary markets that folks just aren't going to, which is really an appealing element because a lot of groups do say, unless it's a top 20 MSA, we're not interested. Would you say you're a top 50 MSA type of investor, or?
I'd say generally, yes. I'd say there are exceptions to that. And without getting into specific details,
sure,
we've gone to true tertiary markets, but there was a very important catalyst reason why we were doing that. And we knew we weren't going to be long-term lenders in that region. But from a short-term perspective, it was a fantastic trade. The other thing I'd say is that in these tighter markets with, cap rates, take multifamily in your core markets. You and I had been discussing this, but multifamily, which is a very in favor asset class, I think it's great. There's a shortage of housing in the country, and it's been historically very stable. Cap rates have gone down because there's been a lot of capital that's flowed into it. As a result, when the interest rate environment changes, there can create a lot more challenges for those investors in those core markets. So for us, finding the middle markets that have wider cap rates are a little bit more compelling. So said another way, historically in the core markets, it was very typical for multifamily assets, regardless of what class it was, to trade in the mid 4 caps.
Yep.
In the last couple of years. Now that's changed recently, but with cap rates being a spread to risk free and interest rates having gone out 400 basis points since the beginning of 2022, it's not inconceivable that cap rates should gap out. Maybe it's not linearly the same amount, but if cap rates went from mid 4s to mid 5s, that's a lot different than a cap rate in a second tier market going from a 7 to 8. You have to have a 25% increase in bottom line NOI in these core markets, not to have any diminution in value. Now, there's the counter argument to say, well, they've been really strong growth markets. I would agree with that, but revenue and expenses aren't mutually exclusive.
Right. And it's interesting. You bring up a really good point where you go from a 4 to a 5 cap. That's a 20%, reduction in value. A 7 to 8 cap is significantly less, right? So you're talking only a 10 to 12% reduction in value when that happens. But you still have that same 100 basis point spread delta, which is an interesting component or interesting way to look at it. All right, I'll put you on the spot. The reality is, we all are making investment decisions to cover our downsides, but we're also thinking about the upsides. Where are we right now in your estimation in cycle dynamics? Where are we going? How do we see the next 2 to 3 years? Nobody really knows every part, but I'd love to understand and let the audience know how Bryan and Arena are thinking about the next couple of years and currently where we currently sit too.
Sure, absolutely. I mean, let's think about this. Early 2022 is when it was the early innings of when inflation was starting to take hold. Now, there was an increase in core CPI, and people questioned whether that was a function of just the tail of COVID. But ultimately, it seemed, and it proved to be true, that it kind of bled into the real economy. And when inflation is there, it's really difficult to arrest it. Yeah. Right? We've been trying to do this for 2+ years now, and we hadn't seen it in 40 years. I mean, that's an entire generation, myself included, that, hadn't really understood what that would impact and how long that would impact the financial markets for. Now, the equity markets have been strong in recent days, given all the noise reaching new highs, et cetera. But we believe, I think the house view is that inflation is stubborn and higher interest rates are likely to be here for longer. I mean, if you thought about when we talked to borrowers and proposing term sheets a number of months ago, everybody's looking at the floor. And, one of the top 3 points is, well, what's the floor? Because this is going to be a really steep curve down. We're going to get inflation under control. And people were very excited and the markets were very bullish. But if you look at the curve today, it's flattened considerably. Yep. And so for us to push on having, maybe not deal dependent, but about higher floor today, it's not one of the top 3 points that the borrowers are raising. Sure. So I do think there's starting to be, although I do think it's early, some bit of capitulation. Yep. That's starting to occur. Now, I don't think it really has, but ultimately, if you're asking, what's the current environment, what it was 24 months ago, I think it's significantly different given what we had talked about relative to what people's long-term view is on pricing. And I'd say the other component is it's really hard to determine value today because one of the key pieces of value is cap rates. And cap rates are very much backwards looking.
Yeah.
And when you don't have trades and liquidity the way there hasn't been, it's really difficult. And there's been no price discovery. So as a result, the capital markets have been slow. People aren't putting out money the same way. There's been a lot of dry powder that's been raised. But it is quite challenging because nobody wants to be the first person to dip their toe into the water when there's no real long-term pricing. Because if you look at where cap rates are now, there's a whole segment of the real estate investment universe where their collateral is partially impaired and or the lenders are full dead. You made a point on an unknown deal, but before we joined or when we were talking about this a couple of weeks ago, and a stabilized debt yield at a 4.5 cap is insanity. That's on a stable, like that's full debt to the lender at some point when a borrower executes their business plan. We find the opportunities like those interesting when there will be capitulation and or a borrower's coming in with new money and they've got real skin in the game to add now. And maybe they're trying to claw their way back to maybe a 5.5 or a 6 debt yield, and I'll be deeper in the capital structure, but they're trying to recoup just their equity investment. So
Sure.
do you double your bet to just get your original equity back, which it's possible. And part of that was maybe development costs increasing, duration time, things had been delayed and it's been challenging. But those are the opportunities that we're seeking out today.
I think that's a huge component of where we're going. It's a lot of the things that we're working on. And reality is we are in a new normal where none of us know where interest rates are going. But I do think the fundamentals of what you just mentioned, which is revenues, expenses, and you start thinking like, wait, we're going to have to start operating like real businesses, not just in commercial real estate. A real business thinks about top line, bottom line. What is my profit? What is my NOI? Not just what the cap rate is or the multiple of the business is, because if they thought like that, they wouldn't be in business. They have to manage their expenses. And so, your point about capitulation is an interesting one. I think we're definitely starting to see how some thoughts might be in the market about the duration for how long interest rates will be high. And that hope is never a great business strategy. But the hope for a significant reduction in rates, at least where we sit today in middle of May, doesn't feel like it's going to be as great as we all thought it was. And making decisions about, hey, this may be a longer term horizon. Let's really focus on the revenue and expense side of the ledger versus what we think of values.
Yeah, I think that's a really important point. And part of it, I think we look at sponsors first and property along with that, because ultimately the sponsor has to know how to operate it, right? It's not getting bailed out by cap rates or just macro trends because you happen to be lucky and buy in Atlanta 2 years ago and now pricing is rents are 30% increase from that. You got to look at their ability to manage expenses, and they have to have a track record to be able to do that. I mean, that's critical in seeing. That's, as Warren Buffett said, right? A rising water raises all boats, but when the tide goes out, that's when you see who's naked.
Yep, I think you're definitely seeing that in the market today. All right, let's end this up with a kind of the component of what our philosophies. It's all about the relationships, and it's not just who it's how you know how to get them to do a deal with you. The reality is, what are the best ways for folks to think about that relationship with yourself and Arena? Is it just meeting you at conferences? Is it getting introduced by brokers? Is it directly reaching out? What are the best ways? I want to make sure that this is valuable for everyone that watches this, but what are the best ways for them to say, hey, this is an approach of something. How do we look at this? Do you come in and say, this is how we would look at it? Do you just say, hey, it's not interesting? What's the best way for folks to reach you, Bryan?
Yeah, sure. Well, I'm sure you'll provide contact info, and I appreciate that. But I think the best way, to reach our team obviously is through direct relationships and calling and following up on deals. When I'm looking at a deal, to me, the critical things are how much capital does the borrower have at risk? What are his motivations? What is the business plan that he's seeking to achieve? And how should I be pricing this risk relative to other things I'm looking at in the real estate space? And then equally as important, I'm also looking at it vertically within the capital structure. Where is my attachment point make the most sense relative to getting outsized returns, per unit of risk? So I think for me personally, I think the arc is long in the real estate. The arc is long in our careers. And I think developing relationships over the long term can only help. So going to conferences, I find myself seeing the same cast of characters at the same conferences. So I'll probably take a hiatus during the summer.
Sure.
But I do think, and there probably aren't that many because everybody's traveling, but I do think making really good use of your time when you are in these settings where there are a lot of different brokers. There's no point in going to these conferences just to sit in the panels and hear people prognosticate about where they think the market is. I think the real meetings are those one-off sidebars, and then not just speed dating, but having those meaningful follow-ups in the weeks to come, and then developing that rapport so that you can finally hit on a deal that you've been talking to a counterparty about for many years because you've known them and you may not have transacted, but you actually have a relationship. And I think that's kind of how you start in this industry and you build from that, because it's just building blocks. And you can say, I remember that deal, or I remember that sponsor from 20 years ago. We did this at this conference, or we hung out grabbing beers, or we talked about this deal. What happened to that? Because it's all cyclical, and all the deals that we're seeing come back around. So it's really important to kind of maintain that history and that knowledge base so you can move forward and finding new opportunities.
I always say that this business is about establishing trust, and it's not easy sometimes to establish trust in 1 minute dialogue. You actually have to know someone pretty meaningfully. And if you are going through a brokerage channel or an advisory channel, you're hopeful that your advisor has that relationship so they can help you get introduced and build that. But I closed deals today of folks that I met 20 years ago, and and it feels like, well, we finally got our first deal to get done together, and that's okay, because that's how sometimes it takes. Sometimes it's right away, but sometimes it's a long process. It's a long game. All right, Bryan, you are an absolute perfect first guest for us. Thank you so much for joining. We will, at the end of this, have Bryan's contact information for you to reach out to. And I can't thank all of you enough for joining us today on The Edge, how deals actually get done. Bryan, thank you so much. Have a great weekend with your family and enjoy that beautiful patio area that you can close. It looks awesome.
Thanks, Malcolm. Have a great weekend. Appreciate you having me, and we'll talk soon.
Awesome. Thanks, Bryan.
Thanks.
Thanks for taking the time to tune into our latest show. As always, you can find us through our YouTube channel at youtube.com/@wayontheedge or at our website at www.waycapital.com. Until next time, keep working on the edge.